Hi, everyone. I'm Ian Heller with Distribution Strategy Group, and you have proven that you have the good sense, the common sense, the brilliance and insight to join a great webinar because today we have an economic update, forecast, and M&A trends shaping distribution. This is going to be a wonderful webinar. Let's jump right in. So before we bring in our guests and our sponsors, I do want to say a couple of things about stuff that we're up to here at Distribution Strategy Group. So first of all, if you have not yet signed up for our Profit and Productivity Summit, which is really about how to use new and emerging AI tools to drive new levels of profit and productivity in your firm, you should sign up now. Go to profitandproductivity.com, or you can take a picture of the QR code. We've got John Weborg, who's the CEO of Stellar Industrial Supply. Alex Chasovsky, who's presenting today, will also be giving us an update then. Stu Tisdale, who's the Chief Experience Officer at multi-billion-dollar distributor ADI Global. Tim Brooks, who's the CEO of Low Miller Carrier West in Denver, who's shown extraordinary productivity and profitability through some really innovative methods. Dwayne Roberts, who's the president of Summit Electric Supply. I was honored to know Dwayne well when I was on the board there. Janet Zelenka, who's a former CFO and CIO, both at Stircycle and Ascendant, and was on the Summit board. And Randy McLean, who's probably the world's leading expert on cost to serve. And you're going to have a whole bunch of networking with really bright, capable distribution executives who are really focused on how to drive profits and productivity and using AI tools and other best practices to get it done. It's in Chicago, November the 10th to the 12th. Go to profitandproductivity.com. We will see you there. I also want to talk about our new software package called the Distributor RX Software Suite. We've got Customer Experience RX. This is the best customer survey software out there. It tells you not only how well you're doing with a raw score like you would get from an NPS survey, it also tells you exactly where you need to improve and where you're doing well. Got a customer service problem in Cincinnati? You'll know after using Customer Experience RX. Got an inventory problem in Phoenix? We can tell you that too. You know exactly where to improve. Employee Experience RX is built on the same architecture. This is about employee satisfaction, also a big hit with customers who are using it. And Demand RX estimates sales potential by product line, by account to help your salespeople uncover new opportunities where they should spend their time so they can sell more to your customers. Terrific software invented by my genius business partner, Jonathan Bine, who's got a PhD in computer science in AI. And you can't get it anywhere else but Distribution Strategy Group. Okay, now let's introduce the sponsors who make this fantastic content possible. First, I want to bring in Jason Sullivan, who's the founder and CEO at Distro. Jason, thanks for sponsoring the event today. How are you, my friend?
Thanks, Ian, and good morning, everyone. I'm Jason Sullivan, founder and CEO of Distro. Distro is the complete AI sales platform purpose-built for distributors. From counterstaff and CSRs to inside and outside sales to specialists and project teams, from one-offs to takeoffs. At Distro, our focus is simple. Drive faster quotes, more accurate quotes with better product knowledge, and more revenue per quote. We understand the realities you're up against: tighter margins, labor shortages, rising customer expectations. These pressures are real, but they also open the door for distributors to thrive in new ways. That's really where Distro comes in. We combine quoting automation with AI that understands your customers' needs and takes the next steps, delivering faster quotes, smarter takeoffs, and instant answers. Reps get real-time access to cross-references, accessory and part lookups, product documentation, and upsell suggestions, so they always have the information they need at their fingertips. Next slide, please, Ian.
You bet. There you go.
For leaders, Distro means consistency and visibility across branches and teams, enabled by our white glove service, minimal IT lift, and intuitive user interface. And for reps, new hires sell like veterans in days, while experienced reps spend less time chasing information and more time with customers. I would love to set up a time to explore how Distro can help you take your reps to the next level. Use this QR code on this slide here, or send me an email at jason@distro.app, jason@distro.app. Thank you very much.
Fantastic, Jason. And we're hearing great things from our distributor friends who are using Distro. So I would encourage people to get in touch with you. So thanks again for sponsoring this content. And it's great to see you, my friend.
Likewise. Thank you.
Awesome. So today's program is also brought to you by our friends at White Cup, who's been a longtime sponsor of our content. Todd, thanks so much for sponsoring today. And tell us about White Cup, please.
Happy to, Ian, and really pleased to be here. Good morning, good afternoon to everybody out there. Really pleased to be joining today. I was telling Ian the other day that I saw Alex speak back in February to a large group of fluid power distributors and found his presentation to be both insightful and thoughtful, very reasoned, but also a lot of what he talked about back in February is already kind of proving to be true. So I'm thrilled to be here. I'm looking forward to Alex and Clint's comments. So I'm going to keep my comments short because I'm really looking forward to the presentation here today. But again, my name's Todd Daubenberger. I'm Chief Revenue Officer at White Cup. And at White Cup, we build CRM and BI platforms that are purpose-built for distributors. So if your team is juggling spreadsheets and legacy systems or even generic CRMs, you already know the pain of trying to make sense out of all that great ERP data that you have. And that's where White Cup comes in. White Cup turns that rich ERP data into really clear sales direction, really helping you and your team prioritize the right customers at the right time to take actual or action that can actually drive revenue. Next slide.
You bet.
And there's been a lot of talk about AI, and from that perspective, most AI tools tend to be a little vague or generic or built for somebody else's business model. At White Cup, what we've done is we've used an AI engine to really drive results that your sales and marketing teams can use. And it's available right now, right within our platform. So just a few examples of what I'm talking about there. Buying cycle insights to show you exactly when a customer is likely to buy or reorder before they go cold. Some predictive sales forecasting to give you visibility into what's coming next based on real sales patterns that you have from your customer sales history. But he knows the biggest asset is sitting out in your warehouse. So, helping you move surplus inventory through marketing automation and AI-powered campaigns can be really beneficial. And then another one is, providing your teams tools that they can use out in the field as they're interacting with your customers, and then bringing those meetings, those conversations back, and having some actionable results from those meetings. And even some things like tariff tracking, so I'm guessing that Alex and Clint will be touching on some of that today. We have those types of capabilities right within White Cup. Next slide. And so if you'd like to learn more, love to have a introductory conversation with you. We'll give you a quick walkthrough. Just take a photo of that QR code and we'd be happy to have a follow-up conversation. That's all I have, Ian. I'm looking forward.
It's great, Todd. Yes, and sorry, I didn't mean to cut you off. But yeah, I hear rave reviews from people who use White Cup too. So I mean, these are just such solid systems that you guys have built. So thanks again for supporting today's content.
Yeah,
And
thank you.
by all means, people should reach out to you. Okay, great. Now let me bring in one of the first of our two stars of the show, Alex, my friend. Welcome and thank you for putting together this great content for us.
It's my pleasure. Thanks for having me back. And boy, things are in a very interestingly different place now than when we spoke in the spring.
Yeah.
I'm going to share my slides here because I've got some new content to share with the awesome audience.
Hey, while you're doing that, Alex, hey, we're going to run out of time for questions at the end. We always do. So try to get your questions in early. I'll be moderating them, but there's a Q&A button at the bottom of the screen. So as soon as you can formulate them, get them in.
Sounds great. Yeah, I love questions more than anything else. I enjoy sharing information with the audience, but it's that discourse, that engagement that I really appreciate. So bring your tough questions. I'm ready for them. Let's get going here with this economic and policy update. And I think if I can kind of preface the conversation, I will say that when we shared the views in the spring, the term that I would use eloquently to describe that was uncertainty. There was so much unknown Now that we've transitioned to the second half of the year, and certainly as we go in towards the fourth quarter, I would say that transition has been from uncertainty to complexity. And that is probably going to be relevant and with us for the foreseeable future. So when we talk about an economic and policy update, I wanted to start the conversation around the two major policy initiatives of the Trump administration, obviously being tariffs and the tax bill that was recently passed. Talk about the implications of those, and then review the latest economic data to share where we are today, where we're likely to head towards the end of the year and into 2026. And as always, I'll try to wrap that all into objective analysis, actionable and practical advice that you can implement as you head into your strategic planning sessions this fall, and certainly give you some those tactical initiatives that I think will be beneficial to helping you achieve the kind of performance that you're striving for both this year and beyond. So let's kick it right off, go into the deep end with the tariffs conversation. I want to talk about the geopolitical complexity first. And it's very evident to me that this time around, what President Trump is doing is quite different than what his aim and goals were in the first term in office from 2017 through 2020, in the sense that his approach is to go more unilaterally, meaning that pretty much all of the tariff action that we've seen, with a few minor exceptions here and there, has been through executive order. That is quite different than his approach during his first term in office, when he did try to get the backing of Congress, whether official or unofficial, but he wasn't looking to move himself. He was also adapting a much more surgical, much more tactical and pinpointed approach on tariffs, focusing specifically on the trade embargo and the deficits that he's been railing about his entire political and business career. I mean, it's very clear to me President Trump has nothing if not consistent. He is in favor of tariffs and has been for decades, before any entrance into politics even occurred. But the negotiating points now are also much more complex. So during his first term, it was really targeted to kind of offset some of the dumping that was going on. It was mostly done through Section 232 and 301, and means that there was some research. It was product-oriented, product-specific, and then tried to limit the dumping that was going on by, namely China, into the US market and protecting some American firms. The negotiating points now are so much more vast and diverse. If you can see here, I've got several of the leading trading partners of the United States. On the left-hand side, we have China. Then we have our friendly, non-threatening neighbors to the north and south, and Canada and Mexico, and then some other important trading partners with Europe, Brazil, and India on the docks. And in each case, the negotiating points are quite different and relevant specifically to our relationship with that country. So in the case of the Chinese, yes, of course, we recognize, and the administration has been very vocal about talking about, that China is still by far the largest trade deficit that we have. And so we're trying to balance that out somewhat. But in addition to that, and in some cases more importantly, we're focused on matters of national security, making sure that the United States can produce the type of steel that we need for our military and defense apparatus, to make sure that we have the necessary input materials for our semiconductor industry. So any matters of national security are on the table, as is the conversation around critical minerals. I'll give you a very specific example here. There are two elements called gallium and germanium that are used in both telecommunications equipment production and semiconductor production. And gallium in particular, 97% of that mineral is in China. And really, we have no other way of getting it. The Chinese could potentially cut off the supply. And that's one of the things that's on the negotiating table, as Jameson Greer, the US trade representative, goes back and forth with the Chinese delegation and talks about how can we ensure that there is enough supply of these critical minerals to the US economy and to the critical sectors of the US economy that we need to protect from a national security perspective. Now, when we look at the conversations and the negotiations that are going on with Mexico and Canada, a totally different set of issues emerges. We've got the debate on immigration, and we've clearly seen a huge fall off. We're basically talking about zero illegal immigration at the southern border, essentially the same at the northern border right now. So we've seen some tangible positive developments in that phase. We also have improved drug trade cooperation, and the seizures that are happening, particularly at the Mexican border. Just recently, we had the largest ever seizure of fentanyl in recorded history. So we're really starting to see some of these dynamics play out in a positive way in terms of the agenda and the goals of the Trump administration. But also, and more relevant probably to the distribution industry, is this issue of Chinese transshipments, where the Chinese manufacturers are sending product into both Mexico and Canada, and then that product makes its way into the United States, thereby skirting the sanctions and the tariff embargoes and the tariffs that we have in place on China directly. So all of these elements are on the table. We're seeing traction in immigration and drug trade, as I've already noticed. We've also seen traction related to the Chinese transshipments. In fact, just this week, the Mexican president has indicated that Mexico is likely going to move forward with implementing their own tariffs on Chinese imports to try to stem some of the flow of goods in circumventing the tariffs that exist between the US and China. And then as we move on to Europe, Brazil, and India, we see just how vast and how different these points of consideration can be. Again, certainly talking about evening out the trade deficits that we have with the Europeans, with the Brazilians, and the Chinese. But in addition to that, we want to see Europe spending more on their own defense. There, again, we have some traction. Clearly, countries like Germany, France, the United Kingdom as well, are taking a much more active role. And we saw that play out, not only in terms of the spend, but also in terms of actual action. Just yesterday, we had an incursion from Russian drones into the sovereign territory of Poland. That was the first time ever in history that we had a unified NATO response with jet fighters from multiple countries responding to shoot down those drones before they caused any damage on the ground in Poland. It's clearly a provocation on the part of Putin. It's clearly testing the boundaries and the willingness of NATO to come to the defense of one of its neighbors. And through some of these policies, we're seeing the positive impact of that start to take hold. In the case of Brazil and India, it's a little bit more political in nature. So for Brazil, President Trump had 25% reciprocal tariffs through the IEPA process, but overnight, without any prior indication that this was coming, we saw those tariffs doubled once again by executive order from 25 to 50% because President Trump did not like the way that Brazil was prosecuting its ex-president Bolsonaro in its corruption and graft charges against him. So it's politically motivated. In the case of India, we saw very recently, again, a doubling of Indian tariffs from 25 to 50% in order to discourage them or to dissuade them from buying Russian oil, which, by the way, they get about a 50% discount for. Now, the Indians and the Brazilians have both taken relatively strong stances in opposition. They talk about how unfair it is, how the United States has unrealistic expectations, but both the Brazilians and the Indians are also indicating that they're willing to play ball. Particularly Narendra Modi has indicated that he is coming back to the negotiating table to talk about this issue more, and we're likely to see some additional concessions there. So all of these things that are on the table are part of the discussion, highlight the complexity that's involved in this process. However, it's also not without significant risk. We have seen some wins. We have also seen some threats come out that are very difficult for us to mitigate. For example, in the case of the Chinese, they have shown that they're willing to cut off the supplies of rare earths, which go into everything from AI products to electric motors to anything that's dealing with magnetics. And these are critical components for a whole slew of American industries. China now has a system of licensing and permitting in place that could be used to cut off supplies. They, of course, say this is for everyone, but we are very clear in understanding that the US is the target of that. They can also influence the exchange rate. They can exert influence on the likes of Russia, Iran, and North Korea, which are in their sphere of influence. And of course, the issue of Taiwan is also still very much at the top of everyone's mind in terms of, is China going to actually invade Taiwan militarily or not? So these are all risks associated with a very complicated negotiating posture. On the side of all of the other trading partners, we have to remember that in most cases, these are new governments with unknown negotiators. And sometimes what we don't want to see, which we did see happening last week, is that pushing some of our existing and historically closest trading partners away through this approach actually pushes them into the direction of the likes of China and other American adversaries that we don't want them getting closer to. This is particularly the case in the case of India, where Prime Minister Modi was seen recently with Putin and President Xi, talking about strengthening cooperation between those nations, which obviously is not something that the United States wants to see. So a very clear snapshot of the complexity involved in the tariff regime, and the details here also are quite significantly. There's essentially 3 different types of tariffs in place right now. The first one, which was recently actually struck down as unconstitutional by an appeals court, was the IEEPA tariffs. That's the International Emergency Economic Powers Act tariffs, but President Trump has used, again, unilaterally through executive order to impose both drug-related and reciprocal tariffs on most of our trading partners. And you can see just the variety of rates that are in place based on that. That has now been left up to the Supreme Court to decide. And just this morning, we learned that they have agreed to take up this consideration with a projected hearing date slated for early November. So the volatility in this environment is set to continue. But we do know that, according to President Trump and Secretary Treasury Bessent, that there is a plan B in place. So if these tariffs are struck down as unconstitutional, we are likely going to see a different approach emerge from the administration in order to get some of these policy agenda items across the desk. In the meantime, we still have the Section 232 national security tariffs. Now, those are done through a different process. There's usually some research that's done by the U.S. Trade Representative's Office. They are targeted at specific product categories. And right now, these are some of the strongest tariffs that we have in place, particularly when it comes to steel, aluminum, and now copper, all tariffed at 50%. There's lots of inclusions, and they continue to come out almost on a weekly basis. So the complexity of keeping up with all of this for distributors is also quite difficult, but it's something that is becoming the new normal very, very quickly. So that's why I talk about, the fact that these tariffs are not likely to go away anytime soon. We now have a little bit more clarity in terms of what the trajectory of this looks like, where the tariffs are likely to settle. Many countries already have deals in place. And so now we need to start the adaptation process. We need to figure out how much of these tariffs are we going to be willing to ask our suppliers to absorb themselves, how much of it our American companies are going to be willing to absorb, and how much are we going to pass on to our customers. This is the real nitty-gritty of the work, if you will. The good news when it comes to that front is that right now, it seems to not be having a significantly detrimental impact on the overall economy. It is stifling growth. I would say that they're currently a headwind to more robust, positive growth traction in the US economy. More on that in just a minute. But what I can tell you is that we have currently an effective tariff rate of about 18%. When you take into account everything that's happened from January to today, you can see all of the different changes that have gone into effect. We started the year at a 2% effective tariff rate. We're now at 18%. What does that mean? That means that if you look at all of our imports and calculate reciprocal and other tariffs that exist on all of the different product categories, that means that on average, we're talking about an 18% tariff rate. But the silver lining to this is that we're not seeing companies actually pay that. Now, of course, tariffs are paid by U.S. importers when they take possession of product coming in through Customs and Border Protection. And through these various mechanisms, both asking their foreign suppliers to absorb some of the tariff pain by lowering their prices, by absorbing some of the tariff pain themselves here by U.S. companies, and then passing some of those to end customers. What we're actually seeing right now is that the rate is around 9% currently. That's showing you a couple of things. Number one, it's showing you that while it is a headwind, it's not enough of a headwind to cause the economy to tip over into recession. And number two, that companies are actually focusing more on market share preservation rather than just passing through the tariffs completely to their customers, which is putting strain on the bottom line. And that's why I always try to remind companies that you're in business to make a profit, not just to drive top line revenue, but it's also showing you that it's not acting as a total detriment to the economy in the way that we feared during the initial phase, which was happening in the spring.
So, quick question for you, Alex. So,
Sir.
I mean, imports make up what, 13% of of GDP, something like that.
That's about right. Yes.
So, if you take the effective 9% of actual tariff impact so far, and you say that applies to 13% of the economy, then that would, give you a little over 1%, 1.5% of additional inflation. Is that the right way to think about it?
Yeah, that's a good logical step-by-step way to break it down, Ian, for sure. And that's why I think why we see, for example, the PPI print that came out yesterday actually did not see a significant bump up, whereas people were quite fearful for that. We have seen inflationary pressure build over the last 4 months, for sure. We're up
Right.
by about 0.5 to 1%, as you alluded to, but that's exactly how I would think about it. Yes.
Okay, and then is there a projection that this will change over time, or is it too
Yeah,
soon to tell?
I think that the longer it goes, the more we're going to see the additional cost increases being
Okay.
passed on to customers. I have a slide later on talking about my expectations for inflation, so I'll cover that at that point if you
All
don't
right,
mind.
thanks. Yep.
All right, no problem. So the tariffs are obviously a headwind, as I mentioned, but we also have some positive developments on the policy front. Clearly, the signage of the One Big Beautiful Bill Act into law by President Trump on July 4th was designed to stimulate economic growth, at least in the near term. So whether you like or dislike this particular piece of policy, one thing that everyone can agree on is it is extremely complex and very difficult to understand the full ramifications of. In fact, I recently was at a presentation where I asked a room of about 400 people to raise their hands if they felt like they had a real solid understanding of the provisions that are involved in the OBBBA, and almost nobody raised their hands. And so the first message that I want to communicate on this is you really have to work with a tax professional, someone that can go into the detailed implications of each one of these provisions and talk about how they could potentially benefit you. But clearly, to me, at the surface level, not being a tax pro, I can tell that there are 2 elements that are very beneficial. That's the domestic R&D expenditures being eligible for tax deductions now, and the accelerated depreciation provision. So it's both of those elements are being used, and I know from speaking to many companies, it's being used to offset some of the pain that they're feeling on the tariff front and kind of mitigate some of the downside pressure on the cost structure by realizing some of these benefits coming from the OBBBA. And as I think about the implications as we move forward with this act, I ask myself, is it feasible to ask if the act will boost capital investment? And obviously, this is something that drives a lot of distribution. So what I can tell you is I have done some research, and I looked back at the previous legislation that was the most similar to this, which was the Tax Cuts and Jobs Act of 2017. And we did see in retrospect that that provided about 2% of additional private fixed investment growth. Now, some of that came from the original lowering of the tax rates. Some of it came from the introduction of the 100% accelerated depreciation provision. And so if you look at the impact on CapEx, specifically on business-to-business spending, post TCJA passage, we estimate about 0.5 to 1% of additional investment activity that would happen on the back of this legislation. However, as I step back and try to ascertain the impact of both tariffs and the OBBBA, I say that, and this has been confirmed to me by many people that I talk to that are responsible for pulling the trigger on investment decisions, is the volatility and uncertainty and complexity of tariffs is too much for just the OBBBA to overcome in and of itself. Now, once we have a normalization and a clear picture of what the tariff regime looks like moving forward, then this is likely going to stimulate some additional investment. But as of right now, we're not quite seeing the boost that we were hoping to, because it's not enough to overcome the major uncertainty and volatility related to the tariff environment. So, with those things in mind now, let's take a look very quickly at where the economy is today. First and foremost, zooming out, real GDP, which is already adjusted for inflation, is at a record high as of the second quarter of this year. So it shows you that despite all of the things that are going on, the economy at a macro level is proving to be quite resilient. We are the biggest, most robust economy that we've ever had, despite all of these headwinds that are happening right now. Looking below the surface, this is kind of the raw dollars associated with economic activity. If you look at the business cycle, which I'm doing for you here by looking at quarter-over-quarter growth rate for the same data for GDP, we can see that the last 2 quarters, the economy has grown at about a 2% pace. And despite all of that volatility and uncertainty, we've been able to keep up with the historic average growth rate of the economy overall. Now, that's not the case when you look at the part of the economy that is most pertinent to the distribution community, which is industrial production, or the business-to-business side of the economy. Here, when we look at the industrial production index, which measures the volume of economic activity, what we see is that we actually haven't had any significant growth in this part of the economy in the last 2 years. Now, there has been some revenue upside that exceeds this because of price increases, but at least at the volume level, it's been very, very minimal. And when you look at the business cycle of the industrial economy, what we see is that we had some real tangible momentum coming into 2025. After President Trump got elected in November of last year, businesses were optimistic. They were expecting more deregulation, a more pro-business friendly environment. And as a result, we started to see these growth rates, which here, the light blue line is the shorter term growth rate. It's the quarterly data. The dark blue line is the annual data here. We saw them surge into positive territory for the first time in about 2 years. But as you'll notice here, when we hit the April timeline, this short-term growth rate starts to decelerate and converge with the longer-term growth rate. So we don't have a flipping from growth to contraction by any means, but we do have more of that sideways movement, kind of the loss of momentum, if you will, as a result of the uncertainty that I was talking about around tariffs. So the good news is, industrial economy right now is still up 0.6%. The short-term growth rate being at 1.1 means that we're not looking to decline in the foreseeable future. So I don't expect an industrial recession in the next 2 quarters. But the less good news is that we also have lost that momentum, and we're likely going to be kind of treading water, moving sideways in terms of growth just above the 0 line, which is obviously a far cry from where we could be if all of this policy uncertainty was not in the picture. So as we try to figure out, does this mean that there's more of the same? Is there a better environment for 2026, maybe a worse environment? We have to look at not just the hard data, which is what I'm showing you here, but also the sentiment or the softer data. And here, once again, we have kind of a confirmation of the fact that the business community, after taking a huge hit post-Liberation Day in the sense of optimism and confidence that CEOs reported, we did have a rebound in Q3, both reflecting some of the positivity of the One Big Beautiful Bill Act and some of the kind of clarity that has emerged in terms of what the final trade deals will likely look like, and companies are starting to adopt to some of that. But even the rebound has only been back up to the level of parity. Basically, whenever you are around this level of 50 on the confidence index, it means half are, roughly speaking, optimistic and half are pessimistic. Or you could say there's the inference here that there's not a whole lot of optimism or a lot of pessimism. Businesses and CEOs in particular are expecting more of that sideways movement. So how does all of this translate to wholesale distribution? Well, as a snapshot here, what we know is that merchant wholesaler sales, and this is including the latest data that we have available, are actually up right now. And you can see both at the top level, when you zoom out and look at the 12-month trail, we are now exceeding the previous peak that we reached back in early 2022. This is in terms of overall dollars. On a business cycle basis, you can see the short-term growth rate remains very firmly moving in the positive direction, up at around 5% year over year right now. That's the latest quarter of data compared to the previous quarter. The annual trend line is up around 4% currently. But not all sectors are feeling it the same. And that's why I wanted to show you here the difference between durable goods, which are obviously more CapEx driven, designed to last at least 3 years or more. Durable goods are seeing a lot more positive traction here, with the short-term growth rate up above 12% right now in terms of new orders, and the annual trend closer to 4%. But the non-durable goods, the things that are designed to last less than 3 years, are basically flat currently at 0%. So it does show that there are pockets of opportunity and there are pockets of weakness as well. And if I were to highlight one of the pockets of opportunity, anything technology related, meaning AI components and infrastructure, semiconductor production, data centers, these are areas that I expect to remain very vibrant, regardless of what happens in the policy area, based on the committed spend that we already have from many of the largest tech companies. And this goes beyond 2026. This goes into 2027, 2028 as well. So if you are not exposed to some of those sectors, whether directly or through your customer base, try proactively to find some opportunities to capitalize that, because this trend, in my view, isn't going anywhere. To wrap things up, I just wanted to touch on the weakness that we've seen in the labor market over the last few months. So the latest reading we received on Friday was that we only added 22,000 jobs in the month of August. We did see a slightly higher revision for July, but June was actually revised into negative territory, which is important because that's the first month in almost 5 years that we actually had job destruction in the United States. We also had this major revision that's done on an annualized basis that shows that we actually added about 1 million fewer jobs over the last year that we thought we did previously. And so I would say that it's clear to me that we are now entering a different shift down phase for the labor market. And you can see very clearly the timing of that. Through April, we had consistently, for the previous 6 months, over 100,000 jobs added. Now we've been below that threshold consistently. And so the economy is struggling under the complexity and the headwinds that are caused by this uncertain policy environment. There is a silver lining that I'd like to bring to your attention, which is there's not a corresponding layoff spike that's happening. So if you think about or are worried about a recession, historically, you see these layoffs surge in run-up to recessions, 2008, 2009, the 2020 surge that you can see there. But as of right now, with the latest data, we are tracking at 2019 levels of layoffs. And so we're not seeing the corresponding huge spike in layoffs. My opinion is, as we look to the future, as long as most Americans who want to have jobs are gainfully employed, then we will be able to continue down this path of sluggish, slow, but positive growth. If we see these layoff numbers start to spike, then I'm much more concerned about a recession. In the meantime, the key elements the distributors should be focused on in their strategic planning are, number one, inflation. Inflation, as you can see, this is actually incorporating this morning's read that the overall CPI ticked up to 2.9%, very clearly moving away from the Fed's 2% target. My expectation is that we're going to be somewhere between 3 and 4% on the CPI by the time we round out this year. And it is quite possible that based on what happens in the tariff arena, we see generous upside potential there as well. So it's going to be quite difficult for the Fed to make the new rate cutting a cycle rather than a 1 or 2 off. So we have information from the Fed that right now they are looking towards a general profile of lower rates over time. I believe that there will be a 25 basis point cut at the September 17th meeting. And if those inflation readings rise, but do so in a nominal way, then we might have another rate cut or two before the end of the year. But keep in mind, even with those things possibly in place, we're still only getting back from restrictive territory, which is where we are today, between 4.25% and 4.5%, down towards normal. Normal is on the federal funds rate is considered between 3 and 3.5%. That is considered the level that is neutral. It's not stimulative to investment, nor is it restrictive or prohibitive of investment. We would really need to be below 3% before we started to see the borrowing costs actually cause a surge in the projects getting greenlit and significant levels of capital investment. So to wrap things up very quickly for you here and pass it on to Clint to talk about the M&A side, I want to leave folks with a few strategic considerations as they go to plan. Number one, there's a lot of anxiety and fear out there, and a lot of news articles that are designed to make you scared. Make your decisions and make your plans based on good quality data and a thorough understanding of the policy developments. That means when it comes to taxes, work with a financial tax professional or a consultant to understand the implications of the OBBBA. On tariffs, you have to have someone constantly trying to understand what the latest implications are, what the impact of exclusions are, and that data is coming out on a regular cadence. The administration has taken to releasing a new batch of exclusions every Friday over the last few weeks, and sometimes those releases are quite significant, and so people are having to spend weekends trying to understand, how does this affect me? Also, of course, use operations and sales data, and some of the tools highlighted at the beginning of the webinar are great tools to do that in order to drive that decision-making rather than allowing fear, anxiety, or emotion to do so. Supply chain mapping is critical, in particular as it pertains to future diversification efforts in terms of mitigating the risk related to the trade volatility. But the key force here is you have to be prepared for a variety of different scenarios. It's not just about making a single plan and implementing it. You have to ask yourself, what will I do if scenario A comes to pass, or scenario B, or scenario C? You have to be ready for a multiple set of outcomes. That way, you're not scrambling to develop those plans when things happen. You're prepared in advance, and you can go straight into implementation mode, giving you that first mover advantage out the door. On the tactical side, the actions to implement that I would say to focus on right now are the things in your control. So first and foremost, communication. If you are talking to your supply chain partners once a quarter, increase that by 50%. Go monthly. If you're talking to your best customers once a month, make a check-in bi-weekly. Offer to share information, ask for information in return, and work on building the moat around the relationship with your customers and your supply chain partners that will prevent the worst possible outcome if the economy does turn south. So if they have to cut their orders with somebody, they're not looking to do that with you, but with one of your competitors. Another element of self-preservation is protecting those margins. As I mentioned earlier, seek some savings in the things that you consume as a business. Energy costs can be negotiated down right now. There's some really interesting arbitrage opportunities in shipping and logistics costs currently. And in general, look for ways to diversify the way that you try to pass some of those costs onto your customers. So surcharges and cost plus models have been very effective tools for people. I've also seen them implement a kind of a bifurcated tariff passing on approach, meaning that they've increased prices for only tier 2 and below clients, keeping prices stable for their main and best clients when it comes to volume. Lastly, understand that although the labor market is weakening, in order to be prepared for that next leg upward, you've got to retain the people that you have. The overall nationwide unemployment rate might be 4.3%, but the unemployment rate for mid-level management is at 2% right now. The unemployment rate for engineering talent, 1.4%. So you've got to make sure you're staying competitive and paying your people fairly in order to retain them. They're not as likely to quit on you, but you still have to be competitive for that retention. So if you work on all of these things and consider them during your strategic planning process, you should be able to navigate the current macro landscape with the best possible outcome. So with that, Ian, I'm going to stop sharing, and I'll pass it over to my good colleague, Clint Bundy, to talk a little bit about what the M&A landscape holds for distribution community members right now. Take it away, Clint.
Alex, thanks much. I appreciate it. And I think you've set me up well for my topic here today. And Ian, I want to thank you again for hosting, allowing us to present. My name is Clint Bundy, Managing Director with Bundy Group. I want to do just a very, very quick overview of who we are and what we do so that we can kind of jump into the meatier topics, as they say. But we are a 36-year-old boutique investment bank. Also, you can use the term mergers and acquisitions advisory firm. And what we do is we specialize in representing business owners and management teams in a business sale or capital raise event. So in short, we are almost always helping a business owner or shareholders maximize value in the sale process and help them find the best fit, usually through running some form of a competitive process. We have been active in the distribution and value-added distribution and services sector for more than 30 years. Over that time, we have advised a wide range of companies and successfully closed transactions with privately held clients. And these are just a few representative transaction examples that we've represented over the years. I do understand Ian's going to make available this presentation for the audience. So my contact information is on the back if ever you want added insights beyond what I'll talk about here today or want to have a conversation, feel free to reach out. Just so as we jump into my what I would call M&A market update, which I am going to talk at a macro level, but also going to get into a little bit of the specifics on the distribution and business to business market. I understand that my perspective is both similar and yet different than Alex's, because my perspective comes from an investment banker who is working on a day in and day out basis with privately held companies. And so, yes, I look at the macro data out there like Alex does, but I also look very much at the micro, and i.e., what are we seeing in our own conversations today with business owners? What are we seeing in company financials? What are we seeing in terms of real-time transactions? So that's very much my lens. And so with that being said, where are we today? Well, let me start with positives, but cautiously positive from an M&A market perspective for where we sit here in September 2025. There are headwinds in terms of what we're seeing for privately held companies and the performance that they're driving, and from the financials that we see from companies that we're advising or the conversations we're having with owners and management teams. There are some headwinds. There's a lot of concerns, but I will have to say that for the most part, most of the companies we see within the industrial distribution and value-added services arenas are continuing to survive and even often thrive. That doesn't mean there aren't exceptions to that, but for the most part, we're seeing a lot of positive performance. And there are a lot of strong management teams out there that continue to be innovative and have built a good enough foundation for their companies that they are surviving and thriving even in a challenging geopolitical environment. There's over right now roughly $2 trillion in capital looking to invest in privately held businesses or acquire in privately held businesses. So in short, what you have today is a what I call a supply and demand imbalance. The supply of quality companies looking to sell or be acquired versus the demand of active buyers, whether they're financial sponsors, also using the term private equity or family office, all the same thing, and then strategic buyers. So if you take financial sponsors and strategic buyers and that amount of capital looking to invest or acquire in privately held companies versus the amount of available companies to acquire right now, there's just an imbalance, which works to the favor of business owners, because with that imbalance, that usually in most industries leads to higher valuations. To use another term, it's a seller's market still. Again, some of this gets into the specifics of industry, but in general, you're looking at a seller's market for most industries right now. Buyers are focused on acquiring stable, profitable, and growing companies within almost all industries. And within that, we are seeing, whether it's a strategic buyer or a financial sponsor buyer, a heightened focus on companies that are incorporating technology-enabled services or value-added services into their offering, with the end goal of providing, those companies are providing solutions to their clients. We see the companies that are selling at the highest multiples today, they're often solving a problem and providing a solution for their client, and not just talking about their service or their product. And then to end here on this page, the M&A market, which we're going to unpack this here a little bit more in a couple of slides. 2024 was a rebound year for the M&A market. There were high hopes for 25 going into it, and those have mostly been realized, but they've been tempered a bit by the geopolitical headwinds that we have seen today, or as of today. Just a real brief history on the past, let's call it 10 years of the M&A market. The global M&A market's at the top chart, the North American M&A market's the bottom chart. They're both very closely correlated. It was a sort of what I would call a steady state M&A market from 2015 to 2020. Then COVID happened. The M&A market does not like uncertainty. So where you've got a lot of uncertainty, you can see the M&A market drop in terms of activity or freeze up. It did happen for a relatively brief period of time in 2020, but then it really unwound quickly or rebounded quickly. And so what you saw is that 2020 finished relatively strong, but then 2021 was a monster year in the M&A market, kind of one of these once every 10 or 15 year peaks for the M&A market. Interest rates were so low, valuations were extremely high. You had a lot of sellers, you had a lot of buyers. So that was a high water mark year. 2022 and 23 were reset years. Higher interest rates resulted in a more challenging M&A environment because financing does dictate a lot of activity within the M&A market. And also, I would say just those 2 years were hangover years after a really active 2021. You see, in 2024, we had very much a rebound year, so things were back on the upswing. 2024 finished on a strong note. A lot of deal makers were very optimistic about 2025. The election was behind us. Felt like there were all the right fundamentals in place. But then you get into the question marks around the geopolitical concerns, the tariffs, and many other macroeconomic issues, which can and often do influence the M&A market. So where are we today specifically? Well, through year-to-date June 2025, so the first half of the year, the global deal value and number of transactions are up relative to 2024. So the good news is strategic buyers and financial sponsors are putting money to work. I'm sure many owners on this call or on this webinar are getting phone calls left and right from buyers, and you probably haven't seen that fall off much in the past 6 or 12 months. And where we sit today, I think you're going to continue to get those phone calls. Add-on acquisitions, which is where you've got a platform or a corporate strategic acquiring a often smaller company and tucking it in as a new subsidiary. Those are very much dominating the market still today. These are lower risk deals for a strategic buyer or a financial sponsor, and they can often gain synergies quickly and scale up those acquisitions and get a return more quickly. The B2B sector, which most, if not all, of the companies listening to this webinar will fit under, is up in both transaction value and deal volume in the first half of 2025 relative to 2024. The only but here I'll say is that the financial sponsors, portfolio companies in the B2B sector, they are not selling those at as rapid of a pace as they were, let's just call and when you have a financial sponsor who's not selling a portfolio company, that means they're not overly confident about the M&A market right now because they ultimately are looking to sell in the right market to get the right value. And so that is the only but I would say is that you're just seeing a lot of B2B companies staying within their existing financial sponsor universe and not transacting. I will always like to say to all owners, this market is no exception. Whether it's a good market or a bad market, good, stable, profitable, growing companies will always attract a lot of buyer options and can, in the right competitive process, obtain a premium valuation. And so, in short, what I would say is where we sit today, I am bullish on the M&A market today, but I'm closely monitoring what happens here in the back half of the year. You did see a little weakness happen in Q2 in certain industries. So, we are certainly monitoring what happens here in the back half. I always like to mention to all business owners, management teams that, because I get the question often, well, what's my business worth? Well, what are the multiples trading at? And I can and often do give a lot of thoughts and advice on that topic. But At the end of the day, there's only one way any company is going to be able to determine its value, and that's going through some kind of competitive process where you're pushing the buyers in a disciplined competitive process to pay the best valuation. And in that, that's how you find what the maximum value is and don't run the risk of leaving money on the table. And then finally, let me just hit a couple high notes here about the distribution M&A market, which again, we've been active in the space for over 30 years. It is distribution is certainly a very broad market. It's a very attractive market. It's a fragmented market. There are a lot of strategic buyers and a lot of financial sponsors who are very active in the space. What I would say is we don't see that abating anytime soon. We feel like there's going to continue to be a lot of buyer and capital partner options for owners in this sector. What we do see is that the companies that tend to trade in the higher valuation ranges are offering those value-added solutions that have the sticky client bases, and that are building value with solutions for their clients. And there are a whole lot of different ways that you can segment out value-added solutions. That could be engineering services tagged to a distribution platform. That could be system integration services tagged to a distribution firm. That could be warehousing services. That could be using some technology services to help a client or clients increase their profitability or manage multiple locations or product lines. So many different ways to add value-added solutions. But I can tell you, if you show me a set of financials of a more commodity-oriented company and one that's more value-added, solutions-oriented, I can tell pretty quickly which is which, because there is a huge differentiation factor, usually on the profit and loss statement. Focus on growth industries that you're working in, attractive end markets today that we see, anything tied to data centers and technology components, anything tied to healthcare, anything tied to food and beverage. Consolidation, as I mentioned before, we do expect that to continue. And then final kind of two takeaways is, continue as business owners working to build and run businesses that can survive and thrive. Think about the fundamentals of stability, profitability, growth, and then scale. And then finally, as I mentioned earlier, you're focused on your building value now, but when the day comes that you want to exit, think about competition in a competitive sale process ultimately maximizes value and fit. So with that being said, Ian, I believe I'll turn it back over to you.
Fantastic. Thank you so much. That was really, really good. Alex, thanks to you as well. Really a wonderful conversation. If you guys want to hang on for just a second, let me share a couple of upcoming programs. So if you like our content, come back for more on September 17th. We've got the Sales Reps AI Playbook, What's Working in Distribution Today. We'll be joined by Michael Powers, who's the Chief Digital and Technology Officer and an employee owner at ARG, and Michael Eichinger, who's the Chief Operating Officer at Bay Supply. That program will be brought to you by Infor, and it's going to be really an interesting conversation about AI with sales reps. And then on the 24th, we have the Distributors Technology Dream Stack. We'll have Kristen Tom from WhatCup and a panelist to be named soon from Cognitus, who's an SAP partner. So we're going to talk about really how technology stacks are evolving quickly. And so today's Dream Stack ain't your grandfather's Dream Stack. So please mark your calendars, join us for those. In the meantime, Alex, Clint, thank you so much. Wonderful conversation. I really appreciate your contributions, and hopefully we'll see you soon in one of our programs.
Sounds great, Ian. Thanks for having us.
You bet. Thanks, everyone. Till next time.